All right. All right, we'll get started here. And the basic two parts we're going to be doing tonight, the last two modules, the first one is basically on income, and the second module is on adjustments and credits. So in the first one, we were really talking about, filing status and dependents. So that's sort of like a who's who or what's what. And now it's just the whatever's going to drive the actual return. So these are examples of income that is more or less subject to tax one way or another, at least reportable, if nothing else. The number one is obviously wages, which results in a W-2, and then the rest these are all in alphabetical order, so they're not really for our purposes in any order of how much we would actually see them. But alimony, if the divorce was pending or was finalized before 2019, annuity income, business income, forgiven debts, or canceled debt, dividends. Again, if there's disability involved and you're getting more or less like an annuity check from an employer-funded benefit, gain on the sale of property or securities, gambling winnings, interest, IRA distributions, little stuff like jury duty fees can pop up, military pay. Some of it is non-taxable, like combat pay. Some of it will not necessarily be taxable at the state level, but we'll worry about that later. Non-employee compensation, it's a 1099 this or a 1099 NEC. Pensions, again, the only pensions we'll ever probably see in our neck of the woods are those from the state of New Jersey, because not many people, or things like maybe federal employees, if they are getting a VA pension or sometimes you see like postal workers, other government employees like New Jersey Transit, things like that. But basically, those are the only types of pensions we'll see. Punitive damages, I've never seen anything like that before. Again, state taxes are refundable, but you really have to itemize to have to report that, and almost nobody does. Rents, we don't do rental income, but it would be if you had it. Social Security benefits, again, may not be taxable, but it's always reportable. And if there's anything above or beyond what a scholarship is for tuition, tips, gratuities, and of course the last one, unemployment, is always a tricky one because people still have issues with getting those 1099s from the state. Most people get them online these days. There's not many that we have to send away to go down to the Department of Labor to get the actual hard copy, which they can do, but they have to go down and actually get them. Some things that are not taxable or even really reportable, child support. Again, people all the time say, I pay child support. Why isn't that an adjustment? It's just not. That's just like the cost of living. Damages for physical injury, your federal tax refund, gifts, inheritances, insurance proceeds, selling tax-free securities, municipal bonds, things like that are tax-free. Sick pay is generally not taxable. SSI, again, SSI, we see a lot of people say all I get is disability or SSI. They generally don't get any kind of like statement that indicates what they are getting eventually. And again, it's subject to a whole lot of different things. Supplemental security income transitions to Social Security as far as reporting purposes, sometimes before they turn 65. Veterans benefits are generally non-taxable, welfare, food stamps, and of course, workman's compensation. I mean, generally the rule of thumb is if you get a document that looks like a tax document, chances are it's reportable and more than likely taxable. I mean, these are the more common ones that we're going to see and where they'll go in tax wise. Wage income's a W-2, interest is a 1099 INT, the dividend is a 1099 div. IRA and annuity distributions will be from a 1099-R, and Social Security will be the 1099 SSA. That's the lion's share of what we see. It's on a very rare occasions. We have one woman who comes to Salvation Army who's getting a decent amount of alimony, unemployment compensation, and all other income will get reported at different places within tax-wise, but it will all flow back into Schedule 1, which will be aggregated on the 1040. Now, retirement codes, ignore the state and local tax implications on these, because this was copied from my friends in Pennsylvania, their presentation. Again, almost all 1099 income is subject to tax in New Jersey. For instance, particularly a 7, a normal distribution, which is, again, you're over 59 and a half. And that's just taxed as regular income at the federal level as well as the state. So again, that's the big difference between, well, one of the big differences between Pennsylvania and New Jersey is retirement income, IRA distributions are not taxable at the state level. Again, most, we see plenty of 7s, but we also see early distributions, which are generally going to be a 1. That's folks that are cashing out IRAs early. So not only in addition to the regular income tax do they have to pay at the state and federal level, but they're going to get hit with a 10% penalty as well. Now, there could be some exceptions, in particular for medical issues. There may be issues surrounding other hardship cases. It's very rare that we see that. It's just usually people that just like cash it out because they just wanted to. Disability and death we'll see a fair amount of as well. Disability payments can, when they're below 65, will convert into regular income for purposes of the earned income credit, which we'll get to when we do some exercises in tax wise. The other ones, again, we don't see many Roth distributions. Again, as long as it meets all the Roth issues, it's fine. Again, they don't purchase for long-term care premiums. Yeah, there's not, occasionally we will see a rollover. At least that's better than, there's no tax involved anywhere, but at least that means they didn't cash it in. Reporting income issues with the 1099-R. Box 2A is generally, what we go with the gross amount, and then the taxable amount is almost always the same for us, particularly if it's coming out of an IRA or a 401. It gets a little tricky when it's in a pension situation, and we'll get into that in a little bit here. Again, if there's Roth distributions, again, as long as all of these criteria are met, it's going to be tax-free. And in any situations, if for some reason either we feel or more likely the client feels that the taxable amount is incorrect and it needs some sort of recalculation, that is way beyond our scope, and they will need to go see either the pension administrator or call their custodian for whoever the IRA had, like Vanguard, Fidelity, whatever. Now, partially taxable pensions and annuities. A lot of this has to do with that question in the advanced test on, again, someone has a contributions to a pension plan and how that is taken out. And at what dates, they started contributing it, when did they retire, and their ages. All of that gets worked into the calculations. Again, we never see this at all. The folks that get a state pension that we see are generally the lower, generally they make lower amounts, so they're not putting in extra contributions. So generally when they retire, the taxable amount and the gross amount, there might be a slight difference, but that's already worked out by the pension administrator. If they go above and beyond that, they have what's called they can use the simplified method or the 3-year method to basically get out their money that they put in without paying tax on it. The analogy, I just came across this recently, is let's say you go into a bank one day, you open up an account with $1,000. 2 days later, you have second thoughts and you take the money out. Okay, so there's no interest, there's nothing. There's no tax situation, just that's like a return of capital, return of principal. So in money that you've put in after tax into another program, whether it's the pension plan or possibly some other annuity product, it's on you to keep track of all that. Maybe the annuity company is keeping track of it, maybe not. Again, if any of that ever comes up, we have no recourse to really help folks. That's way beyond our abilities. I had one person, the state does a very good job of when people do retire, they will give them basically a 1-page letter that says this is your benefit from now till when forever. And this is what your contribution was. And basically you have 3 years to get that. So basically, for most state employees, if they're in the extended plan, their first 3 years of pension will be more or less tax-free. And then whatever their benefit will be subject to tax from there on out. But again, they need to have all that paperwork. They need to keep track of all that, because as we all know, TaxWise doesn't really keep track of that very well. Now, there was some changes. Again, I've left some of these slides in that had to do with COVID. People in 2020 could take up to $100,000 out of their 401s and get the 10% penalty waived. And the idea then is that you're paying the tax over 3 years. We have one individual who Tony has worked with at Hamilton who did this, not nearly for 100,000. But again, he knows that he has to bring back all his stuff every year, so we can make sure that TaxWise handled all that. And that's for all the usual stuff that they could do that had to do with, issues with COVID. They lost their job, they got laid off, they were unable to work, they had family at home that was sick that they had to take care of, things like that. All right, Social Security, again, Social Security comes on the SS 1099, and we'll look at that a little bit later. It also includes their whatever they pay for their Med B premium. Now, Railroad Retirement is a similar product. It comes with it comes in two parts generally. One that it looks like a Social Security statement, and one is a 1099. It's fairly straightforward, but again, if you haven't done many, it can be a little confusing, and it can be easily put in incorrect. Most people who have Railroad Retirement understand that and are willing to like when I get one, I always ask them to wait so I can double check with Tony, and Tony does it with me as well, to make sure that we get it in the right place. It gets a little complicated if they put more money into it, or and also if it's a surviving spouse. If it's her 1099, it gets a little more complicated. But again, not something that we see. I think we had 3 of those last year. All right, capital gains and losses. We don't see a lot, obviously, given our cohort, and they will all go on Schedule D. The good news is TaxWise has that very little, that cute little capital gains worksheet, which allows us to put things in pretty straightforward. We only do sales of stock, mutual funds, and or the principal residence. And we need the sales price, any adjustments to the basis of the asset, whether it's a short-term or long-term period. If there's any capital loss carryovers, again, we worry about the principal residence exclusion. Capital loss carryovers you can only have losses up to $3,000 in excess of your gains. So if you sell stock for $9,000 loss, you can only take $3,000 a year against your other income for 3 years until that goes away. Now, ideally, again, folks that we know have that, we make sure that they know that they had to bring in the previous year's tax return to make sure that we can reconcile that properly. Doesn't happen very often, if at all, with our group. Typically, you get a 1099-B from a brokerage firm or security firm, and you get a 1099-S from a bank for the sale of your principal residence. The basis determination, the original cost of the asset, that would be whatever you paid for the stock plus any increase or decrease due to commissions, fees. Again, if you're buying a house, depreciation, improvements, you put a new roof on, you put a new kitchen, you redid the bathrooms, etc. All of that gets added up. Brokers must report the original costs on Form 1099 unless the securities were sold uncovered, which means that they did not report the basis to the IRS. And then it's, again, if there is any kind of basis missing, it's important to work with the client to find that out. Again, we generally don't see a whole lot of that. Sometimes you can make a pretty good educated guess as to when it may have been purchased, and that's really all the IRS is looking for, a reasonable expectation of what that price may have been. Again, if it's inherited, grandma bought AT&T back in the 20s, your basis there is basically 1, to be honest. But again, we won't see anything like that. Again, short-term holding periods are anything less than a year. Long-term is anything more than a year. And the good news is, again, the tax rate for anything held long-term is lower than a short-term rate. A short-term rate is basically whatever your income tax rate is. Again, we don't see many sales of a principal residence. If you didn't get a 1099-S, then there's really nothing to report. The whole idea of that is that you're indicating to the government how much of your exclusion that you've used. If you sell your home, your principal home that you've lived in for at least the last 5 years, and you're single, you get $250,000 of that is excluded from income. So if you paid $100,000 for a condo and 6 years later you sell it for $300,000, you're good. You know, you're not going to pay tax on anything. Plus, once you add in any improvements, that kind of shrink that amount dramatically. Again, we don't see. I mean, $500,000 to clear for married filing jointly is a big number, even with the way housing prices have gone up the last 5 to 10 years. All right, business income. Again, we don't see a lot of these. We used to, again, our primary ones that we see are Uber and Lyft drivers, DoorDash, Instacart, that kind of thing. And I believe all, COVID, and especially with gas prices being what they are, has kind of scared away a lot of people from doing this. But I may be wrong. Again, the things that we focus on, anything that has greater than $10,000 in business expenses is not something we can look at. We'll come back to have a loss. They can't have employees. They can't use returns and allowances, which is a non-cash method. Everything has to be the cash method of accounting. Any inventory, so cost of goods sold, farm income, depreciation of any furniture, equipment, the home office expense, and self-employment health insurance. Any of those kind of situations, we cannot do the Schedule C. Now, if they have a loss on the business, it says we're not supposed to do it. But the reality is, once you start, you don't know if they're going to have a loss or not to begin with. Chances are, most of the folks that we see driving Uber, Lyft have very, very small profit, if anything. I've done a few this summer from folks that have come in that had tremendous mileage expenses. One woman was a notary, so like a traveling notary. And clearly she's not charging nearly enough because her business miles were outrageous. And it created a pretty large loss, which again, we can't roll over. We can't create net operating loss. We can't do any of that kind of stuff. All it's going to do is mitigate some of her other income. And the issue there is, if you're running a business, Schedule C business, I believe if it's 2 out of 5 years that are negative, then it becomes what they call a hobby. It's like doing something for the heck of it. And the IRS will then start disallowing the loss. So it's kind of important. I have these kind of conversations because, again, it's none of my business what they want to do, but that the fact is that they might want to rethink about what they're doing as far as their business. Business income will be reported on 1099 NEC. Again, that started in 2020. They also may get the 1099 miscellaneous for some reason or another, and they may also get cash. It's important. Again, anybody, we see this all the time with VITA. The only ones that aren't really Uber Lyft drivers are the folks that do house cleaning or maybe some landscaping, and they're paid in cash. And it's important that they realize that they report as much as they can. The reality is, many of our folks are ITIN holders who are cleaning houses, and if they don't report all that income when time comes for a immigration hearing, the judge is basically going to say, for the last 5 years, you've filed head of household with 2 children and you've only reported $5,000 in income. Is that correct? And if the answer is yes, well, the judge is going to be probably not very accommodating in granting citizenship. So it's kind of damned if you are, damned if you're not, because if you report all that income, chances are you're going to owe tax. And in most cases, it's very difficult to actually pay that tax. Again, the business expenses that we can look at, advertising, Car and truck expenses based on the mileage rate. It's interesting this year. Here we go. We got one more joining us. Hello, Robin. The standard mileage rate is in two parts this year. It's 58.5 cents from January to June and 62.5 cents from July to December. So we'll cross that bridge when it comes up, how we do that, how people are keeping track of their mileage. I believe Uber does it on a monthly basis, which will make it real simple. Others that maybe don't, who have a written record but don't have it necessarily by month, and that they feel that they sort of had annualized that they did roughly half their business in the first half of the year and half in the second. We'll do the math that way. Commissions and fees, insurance, business insurance, liability insurance, any kind of interest they may have paid, legal and professional services. If they had they hired an attorney to look at their business plan or whatever. Those are mostly like licensing fees, possibly. If they did have an office expense other than the in-home office, any kind of machinery, equipment rented or leased, repairs and maintenance to computers, equipment, things like that. Office supplies, again, taxes, licenses. Travel is limited a bit. Meals got to be careful too. That's like 50%. Is what meals is subject to that limitation, and utilities. Again, I don't know how we can do that with without using the home office expense, but whatever. I think it's basically more like cell phones, things like that. So, and here's the situation for an Uber driver or other services. They're considered independent contractors, and they must file a return if their net earnings are greater than $400. And frequently, that's right around what the number is. They're going to get their income reported on a 1099-K and or a 1099 NEC, and maybe they report cash as well. And all that comes on the Uber app. They can just open it up and show us. They can email us the hard copy if they can, but it's all on the app, which is very, very easy to use. Again, the expenses include their car expenses based on standard mileage rates, the commissions and credit fees, service fees, that's on there. Maybe they bought some insurance through Uber, specifically liability insurance to cover them. Again, there's other expenses, again, for the business. Again, anything used in the home, supplies. If you're offering bottled water and mints in the back seat, things like that, your cell phone. Again, all that's going to be listed on there. And very frequently, we'll see that most of their earnings are whittled down to next to zero based on the mileage calculation. There's very little earnings that are subject to tax, and then obviously subject to the self-employment tax as well. All right, we have one person, I believe, who's coming back for this, who was self-employed, and you could defer the self-employment taxes over 2 years, over 2021 and 2022. I'm not going to get involved in that because, again, we're not going to see that anymore. It's just something that was in the past, and some of us have to be aware that it may come up if someone comes in that had their taxes done at another site. This is not something that's on the test or anything like that. But one thing that we do see a lot, and we saw a fair amount during COVID, was gambling winnings, and all kinds of other income as well. Gambling is reported on the W-2G, and the losses are only allowed to the extent of gambling winnings, and they must be reported on Schedule A as an itemized deduction. Now, if they don't itemize, they can't receive the benefits of the losses. The interesting thing is we've seen folks over COVID who have done so well gambling and yet they all give it back, almost all of them. You see the W-2G, and they won $40,000 at Caesars in Atlantic City, and they've got the printout from their card that shows that they lost that and more than that. So in that situation, because their losses are so high, they don't need any itemized deductions. They're gonna net that out, which is good. Usually, what we see in the past is, somebody has a couple $1,000s in gambling, or maybe $10,000. So now that they're single, they're below the standard deduction. And maybe or not they can take it again with that extra loss, maybe they can. Again, as long as they have some sort of record of the losses, maybe we can make that work. But that's definitely has happened the last 2 years. We've seen higher winnings and corresponding higher losses as well. Other income that gets reported, jury duty pay, other income, things like 1099 miscellaneous may be sent to a client for temporary work that was done. In my paid practice, I have a guy who helps with parking at the commencement for Ryder every year, and he gets like a couple $100, and they give him a 1099 miscellaneous. So that's going to wind up flowing through to Schedule 1 as taxable income, but it's not like you have to do a Schedule C. And again, even if someone who, like, for instance, maybe gives like an honorarium, does a speech or something, and they get a one-time honorarium of some sort, stipend. Again, it's not an ongoing business, it's just something that happened once, maybe won't happen again, for whatever reason. And so it just sometimes takes a little bit of talking to the client to figure out what exactly transpired with this particular piece of income. All right, another favorite is canceled debt. These are personal debts canceled, and then they can be subject to income tax. They're going to get they should get a 1099-C if canceled debt exceeds $600. And we can handle that if it's personal debt, it's reported on a 1099-C. There's no interest in connection with the debt cancellation. It's not business related. The client's not in bankruptcy, and the client is not claiming the insolvency exemption. Now, certain student loan forgiveness was in scope in 2021. I would imagine that once the administration and Congress gets this whole student loan cancellation sorted out, they'll figure out what to do with the canceled student loan debt going forward. I would suspect that is going to be forgiven, and that will not be reported as income. The one thing that I tell clients when I tell them that they got to pay tax on that, it's like, because it's like income, and like, well, I never got the income, but the good news is you don't owe $1,000. The bad news is you owe 10% on that $1,000. So when you word it that way, it's like, do you want to pay the $1,000, which you don't have anyway, is now going to accumulate interest, or $100, which for most of our clients, all that's going to do is just reduce their refund by a small amount. In some cases, depending on other parts of their return, it could create a situation where they owe. But again, it's almost always going to be less than what the canceled debt was. So just want to take a quick moment just to go through again some of the tax documents that we do actually see. Some of these are old, just don't worry about the date here. Again, a W-2 is pretty straightforward. Most of our W-2s, boxes 1, 3, and 5 here along the left are always the same. The reason that they wouldn't be is if there was some payroll deductions for any one of a number of things. Usually it's a box 12 item, which would be for like a 401k or some sort of 403b retirement plan, in which case this box in the middle there, 13 in the middle, would be checked as retirement. Depending on what was taken out, it could also impact the state wages. Okay, that may have to change. But tax laws will populate, once you type in box 1 and box 2, it will take care of the federal part, and then you just need to confirm state wages and what was paid for state income tax. And box 14 is the statutory withdrawals for state unemployment insurance, state disability insurance, and state family leave insurance. Now, sometimes this is all coded somewhat differently. Some employees are not subject to some of the withdrawals. And we'll go over that as we go through looking at different types of W-2s, because sometimes this is worded differently, how it's presented in box 14. Interest income, again, it's usually in box 1 is whatever they have in interest. This one shows that there was some of the interest, they actually got some interest from U.S. government bonds. Occasionally there is the early withdrawal penalty in box 2. That's on actually the basic test, I believe, to make sure that that's in. Very rarely will we see federal income tax withheld on a 1099. And now we got the dividends, distributions, ordinary dividends, qualified dividends, and capital gains distribution. This is from an account at Edward Jones, which is a brokerage firm. So this is probably in some sort of managed account that there's now ordinary dividends, qualified dividends, but the qualified dividends are subject to tax at the long-term capital gains rate, and then total capital gains, which means although the client didn't actually buy or sell securities, the fund manager behind this particular account did and created a capital gains situation. I think most of us are probably going to notice, again, this doesn't happen with our clients, but with the market down this year, there could be capital gains distributions, even though your account is lower than it was on 12/31 of last year. So that's kind of an interesting situation. Just because your account is down doesn't mean that there may or may not be capital gains distribution, since you really have no control over that. Unemployment. I'm sorry, this is unemployment. Again, box 1 will tell us what it is, and box 4 is the federal tax withheld. Always glad to see when there's federal tax withheld, because that generally means that we're not going to have an issue with unemployment as far as triggering a tax situation. The past 2 years we have, because a lot of the federal money, a lot of COVID money, relief money that went to the states for unemployment benefits, for whatever reason, the state was either reluctant or unable, because the money was coming from a different source, to take out withholding tax. So a lot of our folks got hit with either much smaller refunds, or they actually had to owe. Most of the ones that owed money last year was a result of this. You see somebody with, a single person with $25,000 in unemployment benefits and no federal tax withheld. That's not a good start. When you see that, you generally know that that's going to be bad. The only time when no federal tax withheld is generally when the amount is smaller, and we see this quite a lot with our folks in Trenton. A lot of people who are working as bus drivers, or maybe as like lunch aides or some sort of school aid during the school year. So when summer comes around, they're collecting unemployment, and so maybe they don't have federal tax withheld, because then they need that extra money to make it through the year. But during the rest of the year, it more than makes up for it. So those are the situations we see there. Here's just 2 different coding examples for a state of New Jersey 1099, where the gross distribution and the taxable amount is the same with federal tax withheld. We'll get into this more detail when we get rolling. Again, here's a reminder that the 1099 SSA from Social Security, we always put in whatever's in here in box 5. That's the pink box, even though the benefits paid may be slightly different. In this case, it's $19,176, because out of that, the $1,626 is the Med B premium, and that will flow through to Schedule A for itemized deductions, even though we don't really see, most folks don't itemize, but we'll get into that in the next set here. And then the last one is a canceled debt situation, 1099-C, the amount of debt discharged. That goes on as miscellaneous income that flows through on worksheet 7, which flows through to Schedule 1, which flows through to the 1040. And again, there's no tax ID number that we need to put in for the bank or anything like that. All right, so that's all I have on the income side. Any questions there? Okay, let's just jump in there. We're going to straight over to adjustments to income. Now remember, once all the income's in, you want to try and get as much off of the return by the bottom of page 1. So once you get done with adjustments, then basically everything else is up to the software to figure out as far as what the tax rate is and what their net refund or amount owed is based on what they had already paid. So adjustments are reported through Schedule 1. The adjustments that are within our scope that we see a lot of are the educated in expense, penalty for early withdrawal in the savings account, alimony paid. Remember, if someone's is getting alimony, someone has to it's a two-step process. Whoever's paying it gets it as an adjustment. Whoever gets it reports it as income. The IRA deduction, which unfortunately we don't get to see a lot of because people just can't afford to do the IRA deduction. Student loan interest, the tuition and fees, I kept that there because this keeps coming back and forth that it was not extended for 2022. So all we have is for the two credits, which we'll get to a little bit later. So the educator expense this year moved up $50, so it's now $300 for the tax year. Again, if it's married filing jointly and both are in education, it can be $600. Again, a teacher, instructor, counsel, principal, or an aide in the school. Again, if you homeschool your kid, that doesn't count. And it's just K through 12, no nursery school and no college. And you must be employed at least 900 hours during the school year. And the qualifying expenses are pretty straightforward: books, crayons, computer equipment, paper, pencils, that kind of thing. Okay, alimony paid, again, just to reiterate, these are for divorces after 1984 and before 2019. And again, it's required as part of the divorce or separation agreement. Again, if I'm not required to pay, I can't use it as an adjustment. In other words, even though there was no alimony for out of the goodness of my heart, I send my ex-wife $5,000, doesn't mean I get to make an adjustment. Okay, I'll just keep going here. Okay, the IRA deductions, again, the 70.5% limit was eliminated. Again, you can continue making contributions even if you're in your 70s, as long as you're working up to the amount that you worked without going over the limits. So in other words, if you made $3,000, you can contribute $3,000 to your IRA. Again, the limits for 2022 are $6,000, $7,000 if you're 50 and over. And again, that may or may not be applicable if your spouse was covered by a retirement plan at work. Student loan interest deduction. I mean, the one last thing about the IRA deduction, that can be a handy tool in reducing tax limits, because again, you can make that IRA contribution during before the April 15th deadline. So at the end of the tax, if you put everything in and the client owes, it may make sense for them to make an IRA contribution to lower what they owe or make it get as close to zero as you can. The reality, of course, is unfortunately in our world, folks don't have that kind of spare cash to make that adjustment. Student loan interest, again, it's a qualified loan for the taxpayer spouse, a person who is dependent of the taxpayer at the time of the loan. Again, they must have been at least a half-time student at an accredited school at the time of that. Again, either it's the amount that they paid up to a maximum of $2,500. If they're married filing separate, they can't claim the interest deduction. And again, it must be the person who's taking the deduction must be legally obligated to pay the loan. So maybe they are co-signing it, and mom or dad can take the deduction because junior is still either in school or hasn't found a job yet or can't afford to make the loan payments. Again, there's a lot out there on this. Again, as long as the taxpayer's name and social is on that 1090 on that the tax document, we're good for them to claim that. Some other non-refundable credits that come up occasionally: the foreign tax credit. If the tax credit is less than $300, what usually happens there is the taxpayer may have some money in a mutual fund that owns foreign securities that they get a credit for the tax that was paid on that. We generally don't have to use Form 1116. We can just go right to the 1040 and put that in. It takes a little, I always have to remind myself where exactly it goes for reporting the foreign tax. But again, that's a non-refundable credit. So non-refundable credits reduce the overall tax burden. In other words, if the tax burden is zero already, non-refundable credits don't help because you can't go below zero. Now, credit for child and dependent care. This is a bit different than last year. We're back to a $3,000 minimum or maximum per child, $6,000. It's partially refundable in 2022. Again, it's a fairly straightforward process. The client should be getting a 1099 or rather a receipt from the daycare center that says so-and-so was, had this much in aftercare expenses. Same thing if it's a dependent care. An older person is going to senior center for daycare or whatever, to a senior center, that can be deducted as well. Again, they must be 13 or under, dependent of the taxpayer, or a dependent who is physically or incapable of caring for themselves. Obviously, with a 13-year age bracket, the thought there is, if they're 14, they come home from school, they can take care of themselves. The qualifying person must live with the taxpayer for more than half the year. Again, if they're married filing joint, both spouses must have earned income. So if mom or dad are not working, this is not going to work. Okay, then presumably they would be in a situation to care for the child. Again, if it's childcare, so that mom or dad can go to the gym or go out with the gang or whatever, that's not going to fly either. Again, we don't see a lot of dependent care because, again, that's additional money that folks have to pay to keep their job. Either they're getting employer-sponsored childcare or possibly there is a family member and maybe they're doing some sort of payment system, but again, it's not reported. It's nothing we can do. Now, there are two types of credits. We do see both of these, the American Opportunity Credit, which is the big one, and the Lifetime Learning Credit. Taxpayer, spouse, or dependent claimed on the return who attended an eligible post-secondary education institution. They cannot be claimed as a dependent on another return. Again, we can't be doing it if it's married filing separate. Qualifying expenses are tuition and any related expenses requiring things like books, maybe some sort of supplies. If they're an art student, that can be quite a bit of extra expenses as far as art supplies, things like that. Stuff that's not qualifying expenses, room and board, any kind of living expenses if you live at home. Commuting is not an expense. Parking permit is not expense. Lunch at the student union is not an expense either. The American Opportunity Credit maxes out at $2,500. $1,500 of it is non-refundable, and $1,000 of it is refundable. So in this case, that maxes out at $4,000 of costs. So when you get the 1099-T from the college, there'll be the amount paid, and then there'll also be a box there for scholarships. If the scholarships is more than the tuition amount, we really have nothing to do. Basically, they're going to school for free, so there's no credit then. They actually have to be paid out money for tuition and or expenses. If it's a significant amount over, we see this occasionally with our clients' kids that go to like Mercer or Rutgers. They could be fairly generous scholarships, and as long as it's not dramatically over the tuition amount, because then you add in things, books and things like that, then we don't have to report it as income. If it's significantly over, well, let's just say, for instance, they went to a private school, and the scholarship amount is well in excess of tuition. Chances are that they're getting extra money for room and board. Then that must be reported as income. We try to be pretty flexible with that, because usually we don't have that. It's usually maybe a couple $100, and that clearly is meant for room and board. Again, the student must be enrolled in a program that leads to a degree or certification, and must be at least a half-time student. It can be no felony drug conviction, and we'll show how all this has to be acknowledged within TaxWise. Now, the lifetime learning credit is non-refundable. It's $2,000, so 20% up to $10,000 of expenses. You can be doing this for quite a number of years. We'll get back to that in a second. Again, same thing, fees, tuition, books. There's no requirement for halftime. And of course, there's the felony drug conviction thing. A lot of this falls in line mostly for folks that are in grad school. Again, if you're taking one class, the credit may only work out to a few $100s. That again is a non-refundable, so it reduce the amount, the actual tax paid. Now, the thing with the American Opportunity Credit, it's good for 4 years. And one thing that clients need to remember is that in general, the first year of the credit, because remember, a school year goes over 2 tax years. So if they graduate in May, like in most high schools, and they start college in the fall, that's when this process usually starts. Because remember, you're going to get the bill for spring semester before the end of the year. And generally that's got to be paid either through loans or whatever. But the 1098-T is going to show the amount for the full academic year across both tax years. So the upshot of that is when they graduate 4 years later in the spring, there's nothing to be filed for there. Some folks, I had one family who insisted that I was wrong and they were right, and they wanted to go for that extra year. So I don't know how that works out. The federal government is very, very keen on that. If you try for more than 4 go rounds with the American Opportunity Credit, you will get a letter from the IRS. That's a given. Unfortunately, TaxSlayer does not. TaxWise does not keep track of how many years you've used. It's kind of up to you, and if the client doesn't know or is not sure, we have to kind of go on sort of like a best guess kind of situation. Retirement savings contribution. This is something which we do see a little bit of. These are folks that have a retirement withdrawal plan at work. So they're deferring some money into either a traditional IRA or Roth IRA through a 401 or 403B. Maybe if it's a government plan, a 457. And that will be populated. Usually the code in box 12 is an H. And what, again, this will already, the retirement savings credit is non-refundable, and that will be automatically calculated by TaxWise. You don't have to do anything for that. This is a really easy one. So, but again, it's important to get all of this stuff off of the W-2 correctly. Okay, we're up to the refundable child tax credit, and I left the last year's version on here because we may see some folks who are filing for last year, and the difference between last year and this year is dramatic. So for most specifically, it's not $3,000 anymore; it's $2,000, and there's no extra money if the child is under 6. So this line, the second one, goes away in its entirety, and now on, it's back to the $2,000 maximum amount, of which only $1,000 is refundable. So the rest, and it's all based on formula. So again, once we have all the income in, just like in past years, the child tax credit is not an automatic. You're always going to get this. For instance, like if you have $4,000 in education expenses, you will get a $1,000 refundable credit from the IRS. That's a given. That I can do that math in my head. It's a little more complicated back with the child tax credit again. So again, once we have the dependent information in and the birth dates are correct, TaxWise will calculate this correctly. The child must have a valid Social Security number. for this to work. If they have ITINs, they are not eligible. But mom and dad can have ITINs and it'll work. So that's good to know.
Bill, isn't the child tax credit, don't you have to be if you're 17 now, I thought?
It is 17. I'm sorry, yeah, they've got, it is under 17. So you have to be 16 and under. You can't
Right.
turn 17. See, that's the other part too. Sorry, I did forget that last part.
That was actually on the test, so it's like.
That is on the test, yeah. Just like the we'll get into the earned income tax in a minute. Again, this was like what happened last year. Remember, the advance payments started in July of 2021. So we don't have to, and they should have gotten that letter. We don't have to do any of this year. They shouldn't have gotten anything. But again, if we have to do a 2021, they're going to have to show this. The one thing that we had a couple of errors come through this summer. Those 6419 letters had a situation where, let's say it was married filing joint, and they got the $1,500. Mom got a letter for $750 and dad got one for $750, which kind of complicated things up because sometimes folks say, well, I didn't get the letter, so we didn't get the money. And it's like, are you sure? Oh yeah, I'm sure. Well, that's probably not the case. The case was either maybe the letter was lost, stolen, thrown out. Who knows? But the idea is that, what happened last year is a dramatic change for this year. I mean, this amount here is gonna, people are gonna be missing a minimum of $1,500 on their return, and possibly more, because remember, a lot of our head of household folks have no taxable income. So all they're going to get is $1,000. Last year they got $3,000. So these refunds are going to be down dramatically this year. I mean, I know, I think, because we do have quite a few of last year's volunteers on this call, that we were trying to prepare people for this inevitability, that what happened this year was probably not going to happen, because there clearly did not seem to be the will of Congress to renew it in last summer, and certainly, coming into the election cycle, that was not going to happen. And now that we're 3 weeks away from the end of the year, I don't see it happening, even though the Democrats might be able to get something through. It's just done. It's not going to happen. Credit for other dependents. This is a fairly easy one. These are for dependents who do not qualify for the child tax credit. Generally, these are relatives that are living with the client, or maybe an older child who is not in school. My 30-year-old son who's just laying on the couch playing video games. He is worth at maximum $500 to reduce your tax amount. That's it. Can't be the dependent cannot qualify for the child tax credit or any other taxpayer. The dependency test, and as a qualifying relative, they must be a U.S. citizen, yet U.S. national or resident of the U.S. This kind of throws out the folks that they're not residents of Mexico or Canada. This will not apply. Now, again, they must have a valid social security number for this, ITIN or an ATIN for this to work. And yeah, I think that's it. That's it for other dependents. Again, mostly it's generally the older dependent child who is still hanging out in the house that we see the extra $500 for. Now, the earned income credit is the other big one that we've seen some changes on. And to qualify, the main thing is you must have earned income for starters. And it can be wages, self-employed business income, and it could be taxable long-term disability payments prior to my minimum retirement age. Now, what that means is you're going to get a 1099 with a code 3 for disability, and there'll be a little box there that you check to, and it will basically convert that income to wages, and it will then maybe trigger the earned income credit, depending on other situations. Because remember, it's still, those disability benefits are still subject to income tax. So whether it's treated as 1099 income or W-2 income from an income tax standpoint doesn't matter. But if it stays as 1099 income, it's not going to help them for the earned income credit. Investment income may not exceed $10,000. Why they have that number in there, I have no idea, because if you have that kind of investment income, you're not gonna qualify for the earned income credit anyway. But whatever, that's in there. You can't be married filing separate. The taxpayer and spouse must have socials. All children must have socials to be treated as qualifying. They cannot be a qualifying child for another person, and this credit was not previously disallowed. We will see rejects sometimes because apparently it was rejected, and it's unclear, why that happened. But we'll reapply it with the appropriate form, and it generally goes through. Qualifying child rules similar to dependent rules, except the support test does not have to apply. The residency test applies only if the child lived with the taxpayer for over half of the year. This is the table this year for how much they're going to get, and you can see it drops pretty dramatically. Let me just try and blow this up a little bit here. So, for instance, if you're filing single, and there's no children, and you make maximum of 16, it phases out completely at 16,480. The max you're going to get is $560. Last year that was $1,000 more than that. So that's a problem. The other thing that is not on this slide, but the big change is there is the age limit is back on. So before there was no upside limit. So if you were 65 or under, you got the credit. Last year, they took away from that. So we had some people who had been working and they were in their late 60s who hadn't been getting the credit. Suddenly they got that credit last year. Now they're not going to get it this year. This is also on the test, this particular question about someone being 72 and getting the earned income credit. This is quite a drop across the board in all respects. The numbers, with the child tax credit and everything are still a nice number. So, for instance, let's just say you've got 3 qualifying children, the max. So that's $7,000. Okay, and remember, this is and we're looking at a single person here. This is the max amount. Remember, it's the earned income credit goes on a bell curve. So there's that sweet spot where you're going to get this max, which is almost $7,000, and that's going to be below 53,000. I think it's probably going to be like 41 or 42, something like that. So you got that, and you get the $7,000 earned income credit and the $3,000 child tax credit. So that's roughly a $10,000 refund. So you're looking at maybe low 50s in total income for a family of 4 in this part of the world. We all know that's not living first class, that's for sure. But again, these numbers are going to be dramatically different because they haven't, the earned income numbers are lower and they're not getting the advanced child tax credit. So again, I tried to warn people about this last year, but it's obviously going to be a surprise.
So you're not entitled to the credit if you're over 65 this year?
That's correct.
Really?
Yep. Kind of a bummer, to say the least.
I thought, okay.
Yeah. So the energy credits are still back on. And this mostly has to do with folks who do the put in new windows, doors, a roof. You get a $500 non-refundable credit, a one-time only. So you put in $15,000 worth of new windows, you get deducted your taxes by $500. Now, this is something that's not only new, but it's not new, but TaxWise has been upgraded to take care of this better. Medicare waiver payments. So taxpayers can receive payments under Medicaid waiver payments, not Medicare. Taxpayers can receive payments under the Medicaid waiver program, providing non-medical care in their homes to eligible individuals. That's usually family members, mom or dad, an ailing brother, sister, whatever. These payments typically are reported on a W-2, but are exempt from taxable income. And what happens is that they will be used to calculate the earned income credit. So this kind of gets, in combination with the 1099s for disability income, this can be a way of getting people the earned income credit. Now, the good news is there is a box in TaxWise now, which refers to IRS notice 2014-7 that will take care of this. In past years, I think Lois and I have done this, I think Marina as well. These folks come in with these W-2s and they're very strange. And usually the reporting on the actual W-2 says in care of John Smith, which was the taxpayer's father. And sometimes it's reported different ways from different organizations. Hopefully, this will allow this to happen. We've tried several times. We know that people get paid, let's say it's not a lot of money. It really isn't. But the idea there is the state is doing, it's much beneficial for the state to pay family members to take care of their loved ones in their own home, rather than have this go to a Medicaid facility where the state is going to be on the hook for a lot more money. So these are folks that are probably, hanging on by living at home, by getting care from their loved ones. So hopefully this will work out. Several times we had to give up on folks because we couldn't get it to work in the software. And it didn't really make sense to try and do a paper return. But hopefully this will help us out a lot this year. Okay, itemized deductions. All right, again, most of our folks, the lion's share of our folks, do not itemize. And if we were going to do it, this is how we would do it to see if they would. Occasionally, like higher earning single people who obviously have the lower standard deduction, but have a home mortgage and pay real estate taxes, and maybe they're fairly charitable, can go over that standard deduction threshold, which is right around $13,000 for a single person this year. So again, their out-of-pocket medical and dental expenses have to be over 7.5% of the adjusted gross income. Mortgage interest, mortgage insurance premiums, real estate taxes, their state and local taxes, gifts to charity, and gambling losses that may cancel out their winnings. It's important when people say that they have all this stuff to kind of take a review of what they have and remind them that all this has to be documented, because these are things that can trip up folks, particularly medical and dental expenses. Now, with the state and local taxes limited to $10,000 on the federal return, chances are a lot of folks that are married are not gonna meet that threshold. The good news is, by putting things in on Schedule A, it will flow through for the state of New Jersey. So if they have medical and dental expenses and we tidy them up, and let's say it's $400 because they got some glasses and they had some dental work. Okay, great. That may actually, because the threshold is only 2% for New Jersey, and because there's no taxable income for Social Security and some other sources like VA pensions and things like that, chances are the 2% threshold will be met with even modest medical expenses, particularly on the dental side, because even people with good dental insurance are always paying a fair amount of money for orthodontic work for their kids, or root canals or crowns. That's all out-of-pocket money. So we have to be careful with kind of just dismissing that the idea is that nobody's going to itemize until we get an idea of maybe they have some medical expenses. And remember, their real estate taxes should flow over for New Jersey, and they'll get some credit for that. Again, if they have no taxable income and they're over 65, it should trigger the $50 refund, which again, we saw about 100 of those last year, where folks had no taxable income. So they had no withholding, because they don't have to have tax withheld, because they're not going to have any tax owed in New Jersey. They will get a $50 refund if they're paying rent or property taxes. So for the lion's share of our clients who are renters, when we get to the New Jersey return, all we have to put on is the school district code, the amount of and the amount of rent that they pay. That's it. Now, there are some situations where again, depending on the amount of income they have, we may need to know some other things. For instance, are they veterans? If they're a veteran and they've sent in their discharge, a copy of their discharge papers to the state of New Jersey, $6,000 of their income is not subject to tax. And if it's married filing jointly and both were veterans, $12,000 is not subject to tax. Again, this is something we don't want to like gloss over because it can mean a reasonable amount of money. I mean, it's not thousands of dollars, but it could be easily several $100s more refund for our clients. So we need to be careful with that. Again, young people who didn't serve or whatever, you can kind of figure that out pretty quickly. But again, a lot of veterans tend to be senior citizens and they're subject to the $100,000 exclusion. So they're not going to have tax due anyway. So again, it's getting back to the idea that you can't go below zero. Again, the medical expenses that are, you can claim, they're both for you, your spouse, dependents. It includes out-of-pocket medical, co-pays, dental. If they are paying long-term care premiums, prescription medication and other programs, and of course, medical miles. If you're driving around to different doctors, in my paid practice, a lot of people track a lot of miles, particularly if they're going to specialty care in Philly or New York or New Brunswick. I'm going to spend a little time here on the Affordable Care Act because we had a number of returns last year that got kicked back because I guess we didn't have enough due diligence in making sure that when they said that they did have insurance, that it was through the marketplace, and that they understand that the marketplace was healthcare.gov, which if you go to healthcare.gov right now and you want to go to and you're a New Jersey resident, it redirects you to a different site. It's essentially the same thing. If they bought insurance, and this is the time of year when you're buying insurance for 2023, you will get a 1095A in January of next year. There's no longer a shared responsibility payment for failure to have health insurance for the federal government, but there still is for the state of New Jersey. Again, after all is said and done, if some of that premium tax credit has to be paid back to the federal government, it was suspended in 2020, but not for New Jersey. I mean, sorry, but not for this year. That's all gone. So we're back to, again, if you overshot that, you're going to have to pay. Again, for each person on the return, did they have health insurance? Again, that's part of the question on the intake form. Now, the premium tax credit is just basically indicating that did they all have minimal essential coverage that was purchased through the marketplace. Again, when we reconcile this and they get the 1095A, because remember, they're saying at this time of the year, I'm going to make this amount of money next year. And if that number is somewhere between 100 and 400% of the federal poverty line, given the family size, they probably won't have to pay much, if any, of it back. If it goes over, for instance, this is where it gets messy. In other words, they way underestimated their income. So basically, maybe they got the insurance for little or no money. Now, all of a sudden, their income comes in and it's way above that and it blows through that 400% number. Then they're going to have to pay back all of that premium. It generally doesn't happen in our world. It has happened where they have to pay a fair amount back. This usually happens when, again, it's usually a sort of a good news, bad news situation. Maybe during the year, the taxpayer got a new job and suddenly is making more money, or maybe the spouse went and got employment and is now bringing in more money into the household. Those are the kind of things that are a problem. I mean, you can adjust that during the year, but again, most people don't. They usually they get the insurance and either they're paying very little or nothing through the through the marketplace. And they'll come what may when things roll around at the end of the year. Okay, again, they project, again, once you fill things out, they project the tax credit that they're claiming against the premiums. That will report the amount, the 1095-A will report that. The important thing to note is if the client says that, yes, I did get insurance through the marketplace, that we see that 1095-A. If they don't have that, we cannot send it in, because if we do, it will reject. And we had about 16 of those last year. So I want to try and avoid that as all possible. Now, again, it's an easy fix. They just got to get the 1095, and they have to call the marketplace or the insurance company to get a copy of that. We have a couple that are still sitting out there that every couple months I've been going back and was like, we talked several times about this. I can't file without it. I can't get it, blah, blah, blah. So again, it's a situation where we can't do everything for our clients. We can advise, we can assist on a whole lot of different ways, but there are certain things that we can't help them with. This is one of them. Getting old W-2s is another one. Like, oh, I can't get my W-2. My employer won't give it to me. This and that. It's like, well, there's only so much we can do. Here's the 8964. All right, health savings accounts. We're seeing a fair amount of these. Again, these are taxpayer is in a high deductible health insurance plan, which most people are these days. And when you have when you have a high deductible plan, you're generally allowed to have an HSA. Again, most of the folks that have it in our world are generally, many times they don't even know they have it because they're not putting their own money in. It's just the employer throws in $1,000 into the HSA. It's indicated in the W-2 with an inbox 12 with a letter W and the amount. And usually, maybe they're like, oh, is that what that card is? I'm like, yeah, that's what that card is. And, you can use that for valid medical expenses, co-pays, prescriptions, even over-the-counter medical. You will get you should get a distribution that comes from whoever is managing the plan, whether it's like Health Equity or one of those other firms, which shows how much you spent. And again, it won't itemize it. And we generally go on the assumption that all of that was used for valid medical expenses. If not, it would be subject to a 20% penalty. But again, for most of our clients, that's generally not going to be the situation. A lot of them don't even know they have it. But again, we are seeing a fair amount of those these days. HSA used to be a separate test on the within Lincoln Learn. It's now just there's only one question or two on the advanced test. And yeah, I think that was the last thing I have for tonight. Now, any questions out there?
Bill, is TaxWise available?
Well, let me
now?
get to that here. I'm gonna stop the share here, and I'm gonna